Hello, everyone. I'm pleased to welcome you to today's webinar conference on winning formulas for energy storage. Before we begin today's presentation, I would like to go over a few housekeeping items. Today's program will last approximately 60 minutes, followed by a question and answer session. We will respond to written questions at the end of the program, time permitting. Please type your questions into the Q&A widget that is open on the left-hand side of your screen. If you experience technical difficulties during the presentation, click on the question mark icon below the presentation window. The presentation slides are available in the resources section. This presentation is also being recorded and will be made available within the next few days. CLE credits are being offered for this program. We will be announcing the 5-digit code at some point during the presentation. Those seeking Kansas, New York, and New Jersey CLE credit are also required to complete the attorney affirmation form found in the resources section of your screen. When prompted, enter the 5-digit code that will be announced during the presentation on the form and return the form to bnmorrow@foley.com immediately after the program. I will now hand over the presentation to Tom Hoffmann to introduce the speakers of the webinar.
Good afternoon, everyone, or as the case may be, good morning, depending on your time zone, and welcome to our webinar today, Winning Formulas for Energy Storage. It's a intriguing, dynamic, and very fast-growing segment of the energy industry, particularly the renewable energy industry that, for those of us who are in it, which includes myself and my colleague Joel Meister and our 3 terrific panelists, for all of us, it's an exciting place to be in today's energy market. I'm a longtime energy and project finance practicing lawyer, focusing almost exclusively these days and for many years now in renewable energy. I'll first welcome our 3 non-Foley and Lardner panelists because they've given important time both to prepare and to participate today, and we thank them for doing so. We have with us Tom Byrne, who's the co-founder and CEO of Clean Capital. We have with us Krish Kumar, CFO of ES Volta, and we have with us Ryan Miamis, Director of Finance at NLX. Tom Byrne, would you give a little background on yourself and how you happen to be in the room with us today?
Happy to. Thanks very much, Tom. And Joel, thanks very much to Foley Lardner for including Clean Capital in this webinar. I'm excited to participate. Clean Capital is an investment platform that has, since its inception in 2015, focused on driving institutional capital into the clean energy markets. We have, as a result of making a number of investments in solar, found our way over the last year into the storage market, and we'll be making our first investment in a portfolio of standalone storage and assets here in the next couple of weeks. So it's a fast-growing market that we're actively participating in and eager to push forward.
Well, we're glad to have you, and thank you. Krish Kumar, could you also just give us the context for your company and yourself and your take on how you've jumped into this business?
Sure, absolutely. CFO of ES Volta. ES Volta is a pure-play energy storage developer. We have 2 operating assets and looking at 7 assets to go into construction in the next couple of years. I joined the company 6 months ago because I believe that this is the solution for the growing renewables portfolio across the country. And prior to this, I was assistant treasurer at NRG for about 5 years. Before that, I ran the treasury finance group at Edison Mission. So been in the renewable industry for a fairly long time, and a big believer of this is where the industry is headed next. Thank you.
Thanks for being here, Krish. Ryan Miamis of NLX, could you tell us your own background and a little bit about the company's play into this business segment?
Sure. Thanks, Tom and Joel, for hosting. I'm the Director of Finance at NLX, which is the Enel Group's Advanced Energy Division, which, among many things, focuses on the behind-the-meter storage market here in North America. I've been with the Enel Group for 6 years, previously focusing on utility-scale wind and solar financing. And we actually recently closed a financing facility with the help of Foley. So glad to be working with you guys.
Hey, we'll take the kudos. Thanks. That's very nice of you. Joel, my colleague Joel Meister does need to introduce himself because he's been very active in this space for a few years. Joel, why are you here?
Thank you, Tom. Good to be with everyone. I'm in the DC office of the project finance team here at Foley Larder, working on a variety of tax and project finance issues for a variety of technologies. However, going back to 2013, I started working on energy storage, particularly around electric battery storage projects, especially in the solar plus storage sector of energy storage. I worked in-house at a solar plus storage developer for some time before working on energy storage tax issues at an accounting firm, and then making my way to Foley a few years ago. So across that time, we've seen a number of issues coming up for the development, financing, and operation of energy storage projects, whether they are standalone battery systems or paired with generation, solar, wind, et cetera. And the storage space, I think everyone would consider a relatively new area for development, although deployment is increasing pretty rapidly. But in this new space, we've already received numerous client asks for various services related to project development, assessing opportunities for utility scale and distributed storage projects, drafting storage agreements, which we'll get into a little bit, just the basic structuring and financing of storage projects or storage paired with solar, for example, in a sale-leaseback portfolio or in a dedicated tax equity fund that's a standalone standard partnership flip. But we've also been active in more specific areas, especially around tax, being involved in private letter ruling requests for taxpayers that are trying to determine the ITC eligibility of projects, and even getting into some of the real estate issues around site control agreements, et cetera, and subsequently M&A activity. So have been very active, and I think it's from those activities that we've pulled out a number of issues that we're going to explore today.
Just to explain how we're organizing ourselves, as our moderator mentioned, there is a question box on your screens, assuming you're at a computer, where you can type in questions and we'll get to some of them or all of them as best we can. First, we have a few questions to get the ball rolling on while people log in and get focused. And I want to throw out the first question to Krish Kumar. Krish, an early application to see storage getting significant traction with standalone utility scale projects probably conceived as clones of the operations of traditional power plant for some of the applications. You mentioned your pure play. What drew ES Volta into this segment and has you so focused on the utility space?
Sure, no, that's a great question. Everybody knows California is marching towards 50% renewable RPS. They already achieved the 30% a year ahead of 2020. They're now marching towards 30% RPS standard, and then eventually 50% RPS standard. They recently announced that. And coupled with growing renewables portfolio, so they're already 36% generated from renewables, and only 7% coal, and there is some gas, but not growing. So coupled with growth in renewables, along with shutting down of fossil fuel plants, California isn't building as many fossil fuel plants as they used to, or actually not building any, to be honest. And that's creating a lot of intermittency in the generation portfolio mix that California is heading towards. And that really created a need for energy storage. So renewable intermittency problem, when sun doesn't blow, when sun doesn't shine or wind doesn't blow, we need a generation that readily can come on within a minute or less The gas cannot do that. Gas takes 10, 15 minutes to cycle to get to full cycle. So renewable energy storage is a perfect solution to that, and it's already proving out to be. And California has over 2,000 megawatt hours of energy storage, and we see the trend growing more and more in that direction for the next 10 years at least, to say the least. So think of it as we're pretty much where solar was 15 years ago. There was a lot of talk about solar, and solar was expensive and not be able to install it without tax incentives. So we're there where solar was 15 years ago. There's a growing need for energy storage, especially in California, which is what really caused this company to be formed a couple of years ago. We have 2 operating assets, one in California, one in Ontario. And then we have 7 assets in California that we're looking to construct in the next 2 years. And, we see more states following suit, like with California. So that's really what caused us to focus on this.
Hey, Krish, Tom Hoffmann here. A quick follow-up question about technology and getting utilities to embrace what you're offering. Utilities can be conservative institutions. My guess is you're going through RFP structures to win your projects. Are the utility off-takers that you dealt with so far, are they nervous about the technology? Are they embracing it? How do they deal with technology evolution in a space that's moving along pretty quickly?
Yeah, it's a perfect segue from what we were just discussing a minute ago. So it depends on which state we're talking about. In California, the utilities have some of energy storage on their own, some already RFP'd out and built and operating. So they're learning a lot on how to deal with these assets from a technology standpoint, operational standpoint, and from a grid standpoint, grid stability standpoint. So they are, I would say, California utilities are ahead of the curve compared to other utilities in the rest of the country. So you see less of, hesitancy from the utilities part in California, and also they're mandated to go procure energy storage, right? So they are much ahead of the curve than the rest of the country. But when you go look at other states that are actively joining the bandwagon, they're issuing RFOs primarily to learn the specifics of the energy storage and seeing it as an alternative to gas peaker projects. So you're seeing a lot of RFOs in other states that are posted but not actually awarded because, that's really what's going on as a learning exercise. But not too long ago, we have seen Arizona and Nevada coming out with awarding large energy storage assets. So I think the trend is really continuing, and other states are following soon. So it depends. The short answer to your question is it depends on what state we're talking about. California utilities understand this better, but other utilities are really picking up fast.
You probably have an educational role. We'll come back to that. I want to turn to Ryan at NLX. NL's active across the energy industry, Ryan, but NLX looks like, to us, carving out a distributed storage strategy and maybe pairing it with solar. What is driving your company in any particular market segment direction?
I agree with a lot of what Krish is saying. The future is renewable, and NL has been investing heavily on the utility side on generation for quite some time. I believe we manage about 43 gigawatts of renewables globally, and then there's 5 gigawatts here in North America that we manage. So when you have a grid that's relying on intermittent supply, not only do you want flexible supply, but you also want flexibility on the demand side, which will become increasingly important. So there's that point of view, and then additionally we see kind of these larger trends towards digitalization and customer centricity, which is a result of improvements in technology and business models. C&I customers that we talk to, they have customer choice when they're in order to manage their energy costs now more than ever. So I'd say the need for grid flexibility and customer choice is opening up a largely untapped opportunity for behind-the-meter storage. This led us to the acquisition of Enernoc, which was a pioneer in demand response and demand energy, a storage software company a few years ago. And then since then, we've taken a larger look at the opportunities, and it's clear that solar will play a large role in the behind-the-meter market. From what we see there, we expect about 50% of the behind-the-meter storage market in the next 5 years to be paired with solar. And there's two key reasons for that. We see that customers with existing solar now have compelling load profiles for storage compared to those who don't have solar. And then state-level incentives are driving co-located solar plus storage, like you see with the Massachusetts Smart Program and in New York with VETR and the various storage incentives they offer in New York.
Hey, Ryan, quick clarification for the folks listening in. When you talk about distributed, I think you mean entirely the C&I market. Is that right? We're not talking about anything residential in your business model.
That's correct. We do, NLX does do residential in other parts of the world, but not in North America.
Okay. Tom Byrne, let's get you into this a little bit, CEO of Clean Capital. You mentioned that you're an investment platform when you introduced yourself. Storage is, what should I say, an emerging market, growing as a business segment. As an investment platform, have you gotten comfortable? Why didn't you go to the traditional stuff, generation projects? And I guess it has to do with what you convinced your investors your model was. But tell us about how you got there.
Sure. So we've started as a clean energy investor, and as a result of being an investor predominantly in solar to date, you've sort of back into storage just because it's a natural byproduct of an intermittent resource like solar. If you're going to participate in the wind and solar markets for the next 10 years, you should have a very clear conviction behind storage as well, because they go so naturally together. When we think of it as a long-term owner, it is a new asset class. So I think it was Krish who earlier said, think about solar 15 years ago. People were asking a lot of questions around technology. People were asking a lot of questions about how much the sun shines, when it shines, some various questions that to some of us now might seem pretty basic. But those are the same questions that we're asking about storage now. There's a small handful of leaders on the technology front, name brand battery manufacturers, and so you're looking at technology and getting a comfort around how well it works, how long it's going to work. But the thing that we focus on, and then of course you're going to look at legal diligence and make sure that you have a good asset. But what we really pay most attention to or spend 90% of our diligence on is the revenues, because while solar and storage and storage and wind go hand in hand with each other, they are very different asset classes. Storage is much more like a peaker plant to some extent than it is like a 20-year contracted solar facility. So where we're going to focus most of our attention is on the revenues and how the revenues are generated out of these assets. They're variable by nature. They're not fixed. They tend to be variable. And they tend to be multiple different types of revenues depending on the jurisdiction. So that's where we as a long-term owner will focus most of our time on. And as long as we get comfortable there, we're comfortable making that investment. That coupled with, Tom, I would say, similar to how solar was invested in 10 years ago, is start from a conservative underwriting approach until you increase your conviction in how these assets perform.
Just to confirm and clarify, maybe go a little further with it. Are you agnostic as between utility scale and distributed, or are you deliberately pursuing both?
Well, just by the nature of who we are as a company, we tend to focus much more on distributed generation. It's interesting. I think Ryan was saying it earlier. When talking about customer choice, it's really interesting to just watch how the energy landscape's transitioning right now from utility, fossil fuel driven into clean energy and more distributed. That's not to say distributed is going to totally disrupt utility, but it's going to be much more of a mix going forward. So customers, as a result, in the distributed space, are thinking more about how they're powering their hospital, their university, their box store, and it tends to be a collection. They're increasingly empowered to add solar, to do an efficiency project, to do now storage. There's this really interesting mix that's being created, and that's providing customers with new options and how to power their facilities. So storage is just, because we focus intensely on distributed generation at Clean Capital, our customers, we own the assets, and our customers are the box stores, the municipalities, the hospitals, the community colleges, and it's very natural for us to then be able to offer storage or pursue those types of customers with a storage solution as well.
All right, thanks for filling in the space there.
Tom, Krish, if I may.
Absolutely.
It's interesting. ES Volta is actually the opposite for different reasons, because we're a small but growing company. It's different skill set needed for utility scale energy storage as opposed to C&I or behind the meter stuff. No doubt behind the meter C&I stuff is profitable and has pretty good return on investment, but you need a much larger sales force and connections throughout the country to generate contracts, and it's a different skill set. We looked at both, and we decided to focus on utility scale because of the opportunities out there in the utility scale, and also the nature of our company, given a small company and limited number of people. So it's a very interesting skill set, but both are great opportunities.
Thanks, Krish, and also thank you for illustrating something which I was about to mention, which is, to all the panelists, feel free to jump in at any time, not just when we call on you. Joel, I think you've got a question.
Yeah. Krish, this is actually a question that we can maybe start with you on the issue of utility scale storage. So in some of the early years of utility RFPs for storage projects, and once we got into reviewing actual agreement language, you touched on how utilities have been using RFOs to learn more about the technology and applications, but we also saw a fair amount of learning just through the draft agreements that were initially being proposed and negotiated. And I'm just curious, do you share that assessment that some of the earlier projects, even the agreements and obligations of sponsors, were a little bit more ambiguous, and the utilities have begun to refine the obligations that they're placing on sponsors, at least for specific use cases?
Yeah, no, absolutely. This happened. We have seen this happen in wind more so than solar. In the early stages, people, didn't really know how to. I wouldn't say didn't know, but didn't really test out the wind data forecast we had and how you sign PPAs based on that. And there were issues from both sides, from the utilities and the IPPs, and it took a while for the industry to mature up. And now I think people have a good handle on the wind studies and how to test it and all that. And similar things happening here. There's a lot of learning going on from both sides. So as a result, the PPAs get modified or amended to reflect those things. And what makes it more complicated is energy storage can come from different technologies, lithium-ion, free flow battery, gas compressed storage, and there's different ways, and hydro pump storage has been around for a long time. So each one of them has its own nuances, and within the lithium-ion, you have different chemistries that different companies utilize. So there's a lot of learning for utilities to do, and they're doing so. And as a result, you see that the contracts need to be readjusted or modified, and there's a lot of back and forth we see. And what we also see is ambitious RFOs and utilities having to actually push out the COD date because developers can't just make it because a lot of things are being learned in the industry as a result. So it's taking longer than people assume that it would. So yeah, there's a lot of learning happening here.
Okay, thank you. Ryan, going back to some of the distributed projects out there, I know NLX has had some very public success recently with C&I customers on solar plus storage projects. And following that topic of customer education and what you refer to customer choice behind the meter, it looks like C&I customers do have a variety of use cases at their disposal to make the economic case for storage. So I'm just curious if you can, at a high level, just describe what that customer education process is, especially if you are what they call stacking various use cases and cobbling together different revenue streams. Could you just take us through what those typically are and how you make that case to a customer that may not be familiar with this new technology and what those various uses are?
Sure. And to reiterate, customers are getting much smarter with their energy use and looking at that cost item in their budgets. And while we do see that trend, this stuff is still pretty complicated, right? So storage technology, software, all the various revenue stacking, very complicated topics to discuss with the customer. And then to add on top of that, the industry is still in its infancy, so there's not much historical data that's relevant to show the customer or an investor for that matter. So while we do like to ensure that the customer understands these concepts, we tend to focus on the commercial structures as a way to ensure that our goals are fully aligned with the customer and that they're considered a partner, and they feel that way as well. So for behind the meter storage, we use a shared savings contracting structure. We actually like to call it a shared benefit contract because there are grid revenues and on-bill savings in many of these business cases. The concept is very straightforward, where we'll install and own the battery, pay for the CapEx maintenance, utilize our optimization software to maximize the cash flow, whether that's demand charge management, energy arbitrage, demand response, or even the global adjustment in Ontario. And then we'll split those revenues with the customer. So it creates a situation where if our software performs poorly, we'll feel that the same as the customer does, and there's no preferred split to us. And then if our software overperforms, the customer gets upside as well. And this incentivizes us to both improve our software and to chase new revenue streams that become available in the future that we can't estimate right now. So we explain we'll explain the concepts to the customers, but at the end of the day, when you have a customer that's investing millions of dollars in infrastructure at your school or business, there should be comfort knowing that they'll only get paid back when the customer does.
Okay. Tom, just curious, as you're looking at these projects, when you see any project coming across your desk where you're having those multiple revenue streams, is there ever a concern just in your due diligence that there might ever be conflicting use cases where your confidence in each one of those revenue streams may not be as strong?
Yeah, what we've tended to see is that there's going to be one revenue stream that is dominant. In California, that tends to be some sort of demand shaving we've seen. And to Ryan's point, you make a forecast based on what that revenue is going to be. You then sell it to a customer as shared benefits or shared savings, to steal Ryan's term and that usually is convincing. That should be convincing that everyone's sharing the upside and the downside, and you have a realistic forecast on what that's going to be. So that's California. In California, that's what we tend to see as the demand, the much more focused on demand revenue. Whereas in Ontario, there's this global adjustment rate, and storage is growing there fast. And while there are ancillary revenue opportunities in Ontario, just like there is in California, in Ontario, the global rate adjustment or the global adjustment rate is the dominant revenue stream. That is, the ability to minimize the rate that you are charged as a customer. So to answer your question, Joel, there's always some sort of dominant revenue stream. But to really get the most out of your batteries, you do want to be exploring ancillary revenue streams, whether it's energy arbitrage or other opportunities.
Great, thank you. Tom, just going to stick with you for a minute, kind of in a follow-up and thinking about, again, the investment platform business model as opposed to either a pure play or a developer with technology. In the emerging phase that we're in this business, do you prefer to go look for existing portfolios to acquire, or do you like to get into early stage development? Where's the opportunity?
So clean capital clean capital as a starting place has historically only acquired operating solar assets. We are now making our first investment into new construction solar assets as well, and we have a predisposition to buy operating assets. And the reason for that, of any sort, whether it's solar or storage, the reason for that is we like to see how it runs. It's not necessarily related to construction risk or tax equity. The reason is we like to see how the asset runs, because the one thing we've found is it never runs exactly as you think it does before it becomes operational. There's mechanical issues that arise. The revenues aren't what you think. In the context of solar, the production is either higher or lower than expected. So we definitely have a desire to buy operating assets. The problem with storage is there's not many of them. It is a new market. We have, I think I saw a portfolio on the market either earlier this year or late last year. It was the first portfolio of operating battery assets that I have personally seen come of any size and scale come to the market. So there's very limited number of opportunities to buy operating storage assets, standalone or coupled with solar. So if you're going to participate in this market, you're going to have to increasingly get comfortable buying assets before they hit commercial operation.
Let's stick generally with the concept of the phases of maturity of projects and the transactions around that. Joel, why don't you jump in for a minute? What's different about storage projects in doing diligence for any kind of acquisition or investment?
Sure. And, the panel's already touched on the diversity of projects out there. So in many cases, we may actually be brought in on the earlier stage, I guess more in the development stage, to help sponsors and investors look at potential projects and the overall structuring, be they the actual project documents or even the structuring of the financing. So I thought it'd be good maybe just to go over 9 or 10 high-level topics that typically come up in discussion really at whatever state of the process we're in, just because there is so much variation out there. I always joke that storage is like a Rorschach test where what we may see and talk about may be slightly different than what you see. So we certainly see that our role as attorneys is looking at the documents and what the overall structure is and trying to make sure everyone else understands it as well. So at the outset, just making sure we understand the structure of the agreement. For standalone storage, it's more straightforward, where you have most likely a single energy storage agreement. However, it can get more complicated if you have a solar plus storage system. We'll get into this later regarding ITC eligibility, but in some cases you might have a single PPA that has storage services baked into the document. In other cases, a new PPA may be executed and a separate storage amendment or document will be executed. And in other cases, you may have retrofits where you're adding storage to existing solar projects, and there may be some hesitancy to open up the original PPA that was executed maybe a few years ago with perhaps more favorable terms than they would be able to get, the sponsor would be able to get today. So if there's a hesitancy to open up the PPA, we certainly want to look at any two agreements side by side just to make sure there aren't any conflicts there. Getting into the guts of the agreements, we'll certainly want to look at the specific use cases, be it demand charge management, backup power, more straightforward services being provided to the utility. And often that'll be hand in hand with more technical and engineering reviews by an independent engineer or other financial consultants that might be assisting our client as far as assessing the client's confidence in revenue streams related to those use cases. Oftentimes we'll see terms for storage agreements at 10 years, although certainly have seen shorter and parties discussing longer. And in those cases, we'll certainly look at, for whatever the term is, what are the termination rights, any termination payment obligations of the off-taker. We've seen some agreements where there may be a termination payment owed in early years if the host terminates, but there may not be any termination payments owed in later years. So certainly want to identify where there may be payment obligations or the lack thereof. Next, construction milestones, and this is again a solar plus storage issue that often comes up. Especially if you're trying to claim the ITC on the storage device, we certainly like to see the construction plans for the solar facility and for the storage to be relatively coordinated. We especially like to see that the battery not be placed in service for tax purposes before the solar facility. And as we'll get into later, the goal is to make the case that the battery is part of that solar facility, so we generally would not want to see the battery being able to be operated all on its own, separate and apart from the rest of the solar equipment. Next, exclusivity. If a number of these use cases rely on the aggregation and computation of prior electricity use, real-time decision-making as far as what the load of a particular building might be in the case of C&I. So making sure that the sponsor has exclusivity as far as participation in demand response programs, other utility programs, or even having a say in whether any on-site generation like PV would be added to the site. If you have very specific assumptions about demand charges and demand savings, you wouldn't want to find out that your host customer has separately installed a solar project without cluing you in. Next, just looking at guarantees and any damages that might be owed, whether it's an availability guarantee, a ramp rate, which would require the storage to be back up and running and charged, ready to respond again to whatever the use case is, or round trip efficiencies. So when electricity goes into the battery and is discharged, there's always going to be a certain amount of losses there. So making sure we understand what's the long-term obligation there and making sure they coincide with the warranties that the project has. Two more items I wanted to highlight. Intellectual property. This isn't as often talked about, I found it at conference panels and other forum. But if you're relying on customer data and the aggregation of software activities, a sponsor will want to make sure that they have access to that data to further refine their software and hardware operations. So we'll certainly take a close look at any IP rights or limitations that the sponsor will have. In some cases, we've seen agreements where the sponsor has no ownership of the data produced by the project or delivered by the host, and they would have to essentially destroy that data and not be able to use it for other projects going forward. So we certainly want to make sure if we're looking at a project that they'll be able to continue to use that data. And then lastly, future use cases and incentives. Because this area is shifting, we want to make sure that there is language in these agreements that provide for what the parties will do if there are future opportunities, future incentives that become available, future utility programs that might generate future revenues. And so we always like to raise that to make sure that the parties understand that planning for those potential scenarios are helpful as opposed to running into those in real time and having to figure out who can decide what as far as changing the operation of the battery and use cases. So I know that's a mouthful. So
that's all right.
Back to you, Tom.
The last point you made reminds me of 10 years ago, 12 years ago on the generation side of solar and even wind. And when renewable energy credits were proliferating across the country from portfolio standards, and everybody struggled to define them because nobody knew how quickly they'd change or what new incentive would crop up in any particular piece of state legislation. Ryan and Tom, kind of a heads up, this next question I'm going to kick to the two of you.
I don't think it.
Yes.
Hey, it's Krish. Yeah, from a utility scale, I just want to add on to what Ryan's long list of items. All of that is relevant for utility scale energy storage as well. There's two or three things that we look at more closely is the merchant revenues and understanding the components of the merchant revenues like ancillary services and energy arbitrage and how does it work in California, because it's mainly California right now. CalISO has different products for these revenues, so getting a solid understanding of what these revenue components are and putting a value on them is becoming quite a challenge in putting valuation, because oftentimes we see merchant revenues value exceeds the capacity contract we have with the utilities, and the technology is the second big one. And different battery storage projects use different chemistries, and depending on which one you pick, there are issues come with it, like toxicity when you dispose it. Degradation is different on these, and fire risk is a major thing that we need to take into account. So all of these things. And lastly, I would mention that whether it's good or not, but many large of the manufacturers, the battery manufacturers, are non-U.S. manufacturers, with the exception of Tesla. And getting an understanding of their credit risk and ability to standing behind the contract is another component that we have to closely look at. So.
Thanks, Krish. That was good. Good to know that. So Tom and Ryan, thinking about the distributed generation focus, and thinking about something Tom said, which is if you're trying to acquire a portfolio, there's not a lot of established storage projects out there to buy. Talk to us, if you would, about retrofits or bolt-ons, adding storage to existing solar projects. Is this something that interests you? Is this something you're looking to do? I don't care who goes first. Just need a volunteer.
Sure. This is Tom Byrne. I'll take an initial stab. This is something that at Clean Capital we've explored quite a bit actually in recent months. We have not completed a retrofit yet where we're adding storage to solar, but we are in pretty advanced stages of doing so. The key things that we will look at are, there's a reason to do it. The motivation to do it is, one, you have a very sticky customer, typically in the distributed generation context, that is receptive to, again, we get back to customer choice, that they're receptive to this new new asset, that being storage. When we get past the motivation of the customer and why the distributed space makes sense to kind of look into retrofits, you're then going to quickly turn into some technical and some commercial and legal issues. The first legal issue that you'll have to address is, does this qualify for the investment tax credit? And Joel and Tom could speak to that much more closely. I think the initial inclination is that it will, when coupled with even existing solar, but that's sort of a fundamental factor that has to be analyzed, because that changes the economics on the CapEx. The second part that you analyze is the technical, which leads into the commercial, is how does this fit with the solar? Is it somehow connected to the solar so that the solar is actually feeding the storage, or is it effectively a standalone storage unit that happens to be next to a solar facility? I think it works best. Our initial inclination is it works best if it's attached to the solar and the solar is actually feeding the battery some of the energy. So then you can figure out how you maximize your revenues, and that gets into the commercial question of how are you going to make money on this storage asset. It's almost certainly going to be in a state that has incentives. It's almost certainly going to be in a state that has high power rates, which is why we've focused our analysis on retrofits on really two states, California and Massachusetts, for the same reasons that you focus on those two states, and a handful of others, for a new solar plus storage unit. So that's, we haven't executed on it yet. I hope that by Q1 we are executing on it on a number of fronts, but that's the different points of analysis that we go through when determining whether it makes sense.
Ryan, can I persuade you to jump in?
Sure. I don't have too much to add beyond what Tom has already mentioned. For us, we unfortunately don't have a large portfolio of distributed generation solar, so we don't have that kind of in-house relationship with the customers and the solar. So we get a lot of just kind of greenfield opportunities, or customers that are looking for storage in solar, or just solar, or just storage. So we don't see this too much. I have, in talking to the tax investors about this topic, I think the tax credit issue is a concern. But I think I'll leave it up to you and Joel to discuss that particular point.
We might make Joel do that in a minute, but right now we've got to do. If you ever listen to Wait, Don't Tell Me on National Public Radio, just when things are funny, they take those annoying breaks 30 minutes after the hour. I hope our moderator can jump in, because we have to provide some information for those who want continuing legal education credit on this webinar. Brittany, are you there to do that?
Yes, I am. At this time, I'm going to read the CLE code for this program. If you are in need of CLE credit today, please enter the 5-digit code into the poll question on the screen after it is announced and press the submit button. The code is as follows: F as in Frank, H as in Howard, 780. If you are seeking CLE credit for this session, please complete the polling question by entering the code that was just announced. The polling question will remain open briefly.
Thanks, Brittany. I'm not sure how many lawyers we've got out there that need CLE credit, but we do want to accommodate them. Let's get back to the discussion, and I'll mention to all the panelists we've got 12 minutes left, 11 and a half minutes left, and before we have to break. Krish, could you get us started a little bit, and you've touched on this twice now by my count, on the difference between carrots and sticks, mandates and incentives at the state policy level. You've said a couple things about California, but just bring us back to that distinction.
Sure.
Spend a moment on California, and then I want anybody that's willing to talk about some of the other states, New Jersey, New York. Go ahead, Krish.
Right, sure. I mean, to start with, I mean, we don't have federal incentive like we have ITCs and PTCs for wind and solar. There's a lot of talk about ITCs, energy storage being included in ITCs for future. So that's, let's put that aside for now. And then you drill down to state level incentives. And there are selective state level incentives in California and New York primarily, and we see some in New Jersey and Massachusetts. But in my view, it's my personal view, is those incentives aren't enough to justify a large investment. Maybe smaller projects might be worthwhile, but larger projects, it's a good add-on, but it's not a primary driver in itself. In my personal opinion, what's a bigger driver is really actually the mandates that PUCs pose on utilities to go procure energy storage. And we have seen that a lot in California, and you see a lot of activity as a result of that. And when Aliso Canyon fire risk happened 4 years ago, and PUC basically mandated utilities to go procure X megawatt hours of energy storage, and then they redid it again when ISO did a study on the grid reliability. That actually spurs investment, because that puts utilities on spot to go procure it, and that creates a lot of investment activity and development activity as opposed to incentives, state incentives. And we see that mandate being followed by New York and New Jersey, and I believe Massachusetts to some extent. So I see more of that, and if we can get federal incentive, ITC will be a big driver as well. So,
Ryan or Tom, could you pick one of your favorite states? I don't care if you want to pick Massachusetts, New York, someplace else, and talk about the state programs. Maryland's got a storage tax credit. I don't know if that's attracted your interest yet. You got the energy storage adder in Massachusetts. Where do you think states are making good decisions for incentivizing storage?
I can take that first. Okay. I think the state tax credit, although generous for us, is not too attractive. We saw it with wind and solar as well. States like North Dakota or North Carolina or Oklahoma having these state tax credits, they just add additional complexity beyond the existing tax equity structure. So you have to find investors that have federal capacity and then have state-specific capacity. It's just another layer of complexity that is a challenge, and we try to stay away if we can from those types of incentives. We much prefer feed-in tariffs or upfront incentives. Massachusetts, for instance, you have 20-year feed-in tariff is perfect for not only for regular project financing, but for tax equity to have a solid cash flow that they can look to as a minimum, and kind of help them get over the complexity and the variation of all the other revenue streams.
Yeah, this is Tom.
Tom, would you jump in on this? Yeah, go ahead, Tom.
Yeah, exactly. I echo what Ryan says. I think there's some challenges inherent in the state investment tax credits for the reasons Ryan outlines. Also, my understanding in Maryland is it's a short term, similar to the federal tax incentive, and it ends at a certain time. I'm not certain of the year. So it's sort of like a temporary incentive. We much prefer, whether it's Massachusetts with effectively a 20-year feed-in tariff or Schip in California. These are just fixed guaranteed payments from those state governments. So it's a very strong credit revenue stream. And that's just where we are with storage, in my opinion, is that we're not there yet where we can realistically talk about them being financed without some sort of fixed revenue stream like those incentives in California and Massachusetts.
Just if you can, you mentioned California, the SCHIP program. What percentage of a total revenue stack is that likely to be? How compelling is that as part of the revenue smorgasbord?
Yeah, I mean, it could be upwards of 25 or 30%. I'd have to check our models to see what that revenue stream is, but it's substantial. It serves as a really solid base. In California, the SGIP is paid 50% pretty much when the project's built, and then the balance of it over 5 years in equal amounts. And that, that's just a rock solid foundation of revenue for any investor, whether it's debt or equity, to look to.
That's real money. What about Massachusetts' SMART program, the energy storage adder? What percentage of the revenue flow can it account for?
Ryan could probably speak to that a little bit more closely. We haven't made any investments in Massachusetts yet.
Ryan, can you off the top take a shot at that? We won't quote you.
I'd have to check percentages, but we tend to look at contractor revenues. We include SMART and the PPA offtake. We're investing. When you invest with like a university, for example, we consider that to be a solid credit as well. So we tend to lump those together: the SMART tariff from the utility, and then the PPA, and that's more than enough to get us comfortable with that business case.
Okay. I want to pull back briefly to Joel on one tax question. When we were talking retrofits or bolt-ons, Joel, the question, somebody, I think it was Ryan, said, well, the eligibility for the investment tax credit is always got to be addressed there. Can you give us a 30-second version of what the answer might be?
Yeah, sure. And we can also give a 2-hour answer as well, which we often do. So in general, the regulations certainly provide language that makes clear that storage devices can qualify, but they don't really provide examples of the chronological sequencing. So generally, you look to the general framework for ITC eligibility, and component parts of qualifying property. So, solar energy property qualifies, but what are the parts that constitute that? The buzzword or buzz phrase that we always look to is it an integral part? And so is it used directly in the qualifying activity, and is it essential to the completeness of that activity? So we've certainly gotten comfortable that, at least with respect to the retrofits, amongst other scenarios, that, provided you can confirm that you have integrated the solar and the battery, and you're not just having two separate co-located systems that I think one of the other speakers alluded to, we can certainly get comfortable from a tax perspective that it would be eligible for the ITC, even if the battery is added after the fact to an existing solar project.
Okay, that's details to follow, because it always depends on the facts. We've only got 90 seconds left. Krish Kumar, kick off the last 90 seconds, if you would. How many project finance lenders are ready to deal with the revenue and finance risks that they perceive in financing the kind of projects you're talking about? How much of a bank market's out there for deals like yours?
It's the proof's in the pudding, right? We have to finish the financing to answer that question accurately, but we can certainly estimate it accurately. We're actually actively talking to the lenders to finance our 500 megawatt hours of projects that we have to construct in the next 2 years. The response has been overwhelming, but we have to be careful what that response means, because the lenders are learning this as well as we all do. So there's a lot of eagerness, a lot of appetite wanting to invest in this sector, because as we all know, solar and wind is getting very, very competitive, and not as many PPAs being signed as in the past, especially in wind. So you see a lot of hunger in the lender community, but they want to learn, look at it. The question remains, how many of them actually are going to turn that into commitments, real commitments? I would say, say 25-30% of the total universe in New York, the project finance universe, would be willing to lend towards energy storage projects and willing to take risks. But the terms may not be as, the best of terms that we would like as a sponsor. It may have to be more of a bridge to a permanent financing. but that's really what we're looking at closely. But there's a lot of appetite and interest from the lender community.
Tom or Ryan, in the distributed generation side of the business, do you think any banks are ready to look at a portfolio where a significant percentage of the revenue is from the storage side of it?
This is Tom. So I think they are. But I think just similar to what Krish said, until money starts getting deployed in meaningful amounts, it's more of a flirtation at this point. I think the starting place is, I think we as an equity investor, we have to be convinced of the revenue model, inclusive of the variabilities and risk mitigate around that. And once we're increasingly comfortable, then you bring the lender in to convince them of the same underwriting that you've done yourself.
This is Ryan. The other panelist said it perfectly. Everyone's really excited to talk about storage, and they want to talk about the pipeline, the business cases, very eager. And then I think when you start digging into the revenue streams, more questions start getting asked. How do we mitigate that risk? How do we make sure we're getting this revenue stream and getting into software? The more you dive into the details, the more uncertain investors look when you talk to them. So I don't want to be glass half empty, but it's certainly the beginning stages of financing storage.
Well, it reminds me of 4 or 5 years ago, whatever it was, when community solar was starting to get both tax equity investment and bank finance. And we worked on one of the first community solar deals that did attract bank financing, and it was a very extended diligence process and a comfort building process. And, community solar is not a perfect vehicle for project finance, but a large number of banks have gotten into some of those deals. I want to come back to one last wrap-up question. Joel, I didn't give you quite enough time on the ITC question, but just the dual-use equipment rule. It's for some people on this webinar, it'll be a footnote. For a few people, it'll be a critically important question. Can you just frame that up real quickly?
Sure. So, a topic that often comes up when you get into ITC eligibility issues when you're pairing storage with solar is, can I claim 100% of the cost basis of the battery, an ITC on that, or is there any kind of haircut obligation? The PLRs that came out between 2011 and 2013 provided an evolving view, and more recently, the IRS has said that to the extent you're charging that battery for which you claimed an ITC, to the extent you're charging it with another energy generation source, whether it be a diesel genset for whatever reason, or more likely getting energy from the grid, that you would actually have to apply this so-called dual-use equipment rule that was actually finalized in the late 1980s. So, and in the full slide deck that will circulate to the audience, it goes into the weeds on this, but essentially you have to at least charge the battery 75% with solar to be eligible at all for the ITC. And then beyond that, the actual cost basis that qualifies is whatever your actual percentage is. So if 80% of the battery was being charged with solar over the annual measurement period, you could claim 80% of that cost basis for ITC calculation purposes. So generally, if we are speaking with sponsors that are working, on demand charge management, microgrids, any kind of ancillary services where you're going to be charging and discharging potentially with grid energy, from a due diligence standpoint, we'll certainly look to what hardware and software controls are in place to monitor that and potentially control that so that you don't fall off the dual-use equipment cliff, as they say, and certainly make sure that, if we're representing tax equity, that there be customary language in place that the sponsor would be on the hook for those types of recapture obligations.
Thanks. We are out of time and went a little bit beyond our time. I want to say that our 3 webinar participants today, Krish, Tom, and Ryan, have really shared intellectual capital. And that is a tremendous gift to the community of people trying to get into storage, trying to figure out how to do it, where their place is in this market segment. So I really thank you three gentlemen for your openness, your time commitment, and your willingness to share with the audience the lessons that you've kind of learned the hard way.
Thank you.
Okay.
Sure.
Yep, thanks, Tom. No worries.
Well, thanks, everyone. That wraps our webinar. We invite you to contact myself or Tom if you have any additional questions or would like more information. Just as a reminder, today's program is being recorded and will be available on Foley's website in the next few days. At the conclusion of this program, a questionnaire will appear, so we hope you'll take a minute or two, give us feedback on the presentation, and help us improve our programming going forward. Thanks again to everyone, and we'll talk to you soon.